Hello and welcome to this discussion on the subject of tax incentivized investment schemes. That is how to achieve investment into your SME business that is tax incentivized, basically investment coming from the taxpayer to you. I'm delighted to be joined in this discussion by Declan Doyle, Director with PwC Ireland, Director in the Tax Department of PwC Ireland. And I know, Declan, that you deal with many middle-range companies, many startup and scale-up companies on issues such as tax incentivized schemes.
Yeah, thanks, Martin. Nice to have this call with you. Yeah, absolutely, I do. This is part of what we do day to day. Is Very to deal with this startup and Irish domestic businesses.
And I know from my work in Dublin BIC that you've been a great support to many startup and scale-up businesses over the years. Let's get into it. I'm aware that there is a scheme, the Employment Investment Incentive Scheme, EIIS, through which investment can come into my business and it's tax incentivized. Can you tell us about that, Declan?
Absolutely, yeah. This is a new version of what was the old business expansion scheme, and the business expansion scheme has been in our legislation since the mid-1980s, and now we have this new scheme that has been rebranded as the Employment Incentive, Investment Incentive. What it does is it gives a tax break for investors who take the risk in subscribing for new shares in private businesses, typically startup, scale-up businesses. The relief is in the form of a tax deduction. So to explain it this way, if an investor who pays tax at the 40% marginal rate invests 100,000 for new shares in a qualifying company, they can get tax relief that is valued at 40,000 for them. It's income tax relief. You don't get PRSI relief. You don't get USC relief, but 40% relief is a very, very generous relief. And ultimately what it does, it de-risks the investment. So effectively, for a check of 100,000 that they've written into the business, it's really cost them net a tax 60. So the government has subsidised them in the form of tax break.
Very good. How much can a single investor put into your company?
They can put in up to 200,000. And there's a new scheme whereby an investor can put up to 500,000 for any 1 year, but there's strings attached to that. But ultimately, I suppose one of the things maybe that's relevant is in terms of statistics. Revenue have issued statistics in terms of what people have raised over the years, and they recently published statistics in February this year that takes us from up to 2018. The average investment is in around the 40 to 45,000 mark. Now, I'd say what you'll have is that you have some investors, you only need to invest more than €250 to qualify. And up to 250,000. So the average investor, we'd say, will be in the 10 to 25 to 50. And sometimes if you have significant investors or angel investors, they could put in significantly more money. Okay,
so in the normal course of events, a single investor can invest 200,000 into my company. It'll only cost them 120,000 to do that because they'll get 40% back. And how many investors in the 1 year or over all of time can I do that? Can I have 10 each put 200,000 into my company?
You could. I mean, there are limits. So the annual limit for the company is 5 million, and the company can raise up to 15 million over its lifetime. Okay. Now, the annual investment, it's 250,000 for individuals. So I think the reality is what we see is that the limits, the company limits, are generous enough whereby most companies in the startups and scale-up space will end up being well under that level of fundraising, unless they're extremely capital intensive. And when they come to the next phase of fundraising, it might be beyond the EIIS that they would look for investors.
I have perhaps 3 or 4 investors who are teed up, each ready to invest 50K into my business. Where do I go from there? How do I make it happen?
Okay, and just to take you back one step, there is a requirement to qualify that you must have a business plan. Okay, and the business plan is a very important document. I think it's an important document in its own right, but also it's a key document to have in relation to raising EIS money. You have to have it. It's in the legislation. I think from that you will attract investors, and that will be the document in which you will attract investors. Once you get the investors on board, and in our experience, people should be writing checks not for the tax break, but because they believe in your business. And effectively, the tax break is a bonus. Effectively, it's a subsidy for an investment that they're already committed to. So ultimately, what you do is you have your investor on board, and then what you need to do is write a check to subscribe for new shares to the investor. So the company would allot new shares, take the money, and then what you need to do is spend the money on a qualifying purpose. And that'll be normal business-related expenditure, wages and salaries, rent, rates, all those kind of normal costs. Once the company has spent more than 30% of the amount raised, it can go onto its revenue online account, the ROS account, and actually make a submission via that account by way of a tax return. That for tax return is called a RICT form, RICT. And when you submit it, the revenue will automatically create tax certificates, which the company should receive in their ROS inbox. They print them off, they fill out some manual details, names and addresses, send them to the investor, and that becomes effectively currency for the investor. They can now use that form to claim the tax relief back. And sometimes they wait until they file their tax return, but ultimately that's the process.
Okay, so there's a couple of very, very interesting points there. First of all, I can take the money from the investor and put it in the business, issue share capital in return for it before I've ever made any contact with the Revenue Commissioners or anyone else. So it doesn't necessarily require pre-approval.
Absolutely. Under the old regime, there was a pre-approval process whereby you wrote the revenue and basically filled out a form to say, this is what I'm thinking of doing. Do you think I qualify? And ultimately, you used to get a letter with a harp on the top of it back from revenue to say, based on what you told me, you seem good to go. That used to give a lot of comfort to investors and encourage them to write the check. Now it's changed because of backlogs and difficulties in getting those letters back out. Revenue have privatized that process. So it's up to the company itself to self-certify that it is a qualifying company. But I think it's important, Martin, to say that that doesn't come without risk, because ultimately, if it later transpires that the company didn't qualify and incorrectly issued one of these statements of qualification, the company could be assessed to tax to actually claw back the benefit that the investor has claimed. It's not clawed back on the investor. It can be in certain circumstances, but in a lot of cases, it would be clawed back on the company. So if you go back to my original example, where the investor invests 100,000, they claim back 40,000 in tax. In 2 or 3 years' time, the company, if things go wrong, could be assessed to 40,000 being the clawback amount, which is a serious event and something to be. Therefore, it doesn't come without a health warning in relation to looking after this process.
And to mitigate that risk, it should be possible to talk to an expert such as yourself or another person operating in this area to get a heads up in advance to say, yeah, that looks all kosher, and I believe there should be no risk in that being approved by the Revenue Commissioners.
Absolutely, that's been a service we've run out to a number of startups and scale-ups, where we give the company, the directors, the chairperson, or people who are worried about this, the comfort that they haven't done anything wrong, and that the rules they've been complied with the rules. And the rules, and I know we're not going to get into it today, Martin, the rules are very, very complicated. It's subject to EU state aid rules, and therefore there's a lot of boxes to be ticked. And on that basis, you can inadvertently stray into a pothole. And therefore, that's why we've sometimes been asked to come in and take a look at it and give some kind of assurance to the company that you're on track.
Okay, and connected with that, another very important point you made is that there does have to be a business plan, and the money that's invested in the business plan has to be about executing on that business plan in on the normal operations of the business. I can't take the investor's money and the company purchase a Lamborghini sports car, which it then gives to me as my company car, or the company's sub-office on the beach in Antigua with that money.
Yeah, I can't say someone hasn't tried that in the past, Martin, but the reality is, yeah, no, you have to use it for normal purposes. What sometimes is a little tip that we give people, because you can only issue the cert after 30% has been spent, is we sometimes say to people, why not open a separate bank account into which your money will go, and then you can track that amount in terms of seeing when you get under the 30% ceiling. If you're spending the money on wages and salaries and such normal expenditure, that's qualifying, and it's very easy to kind of monitor, and it's quite easy to spend as well. So effectively, that's what we suggest to people as a little tip.
Okay, this money is invested in ordinary equity in the business. Is there a way to engineer it so that at some point in the future you can purchase back those shares? Can you have it in redeemable preference shares, or can there be put and call options associated with it? If you'd like a situation down the road that, you know, all of the equity of the business is back with you.
Yeah, Martin. They've relaxed the rules in terms of defining the shares. So effectively, they don't have to be a specific locked-in class of ordinary shares. There's quite a bit of flexibility in relation to them. In terms of returning capital to investors, Revenue in the old days, put and call options were used. Currently, Revenue don't like put and call option agreements. And also, in practice, you need to look at the company in which the investors put their money into. Some of these companies are quite early stage, quite risky, and there can be no guarantee that it's going to be a strong enough promoter or anyone to actually promise under a put and call option. So really what we tend to see is that the EII investors are nearly in there with the founder, shoulder to shoulder, and ultimately it'll be a liquidity event in the future that would effectively release the cash to them. And that's where the business plan comes in again, because with discussions with the investors, you'd be hopeful to be the end game probably is something that might necessarily be specified in the business plan, but I think it'd be an important discussion point. The investors will ultimately want their money back, or with a return. That's like any investor.
So you should really enter into it on that basis. Am I right in saying that it is not open for myself as the owner of the business or closely connected partners such as my spouse to invest on the basis of the EIIS scheme?
Yeah, well, under the EIS scheme, there's actually three umbrellas. One is the EIS scheme we spoke about. The other one is a kind of a different version of the EIIS scheme, and that allows family members to invest in your business. And what we typically see will be spouses, brothers and sisters, mothers and fathers, investing in the business. They are automatically regarded as connected people. And if you think about it from a policy perspective, the EU, because they write a lot of these state rules, feel that investments by a father into a daughter's business is kind of a soft investment. It's not really putting money at risk. The parent would probably give the investment anyway. But what they say for micro businesses, that's businesses that are, you know, less than 10 employees, turnover of less than 2 million, they can raise up to 500,000 from parents, siblings, spouses that will qualify. But once you stray above that, then effectively they're not allowed to invest. But Martin, in our experience, at that level of investment, it actually is probably enough for a lot of startups and scale-ups to source money from their family members to actually get a start.
Indeed. And the name on that scheme, Declan?
It's the SCI scheme.
SCI.
SCI.
Very good. Okay.
Sorry.
So that's been really, really interesting, and obviously there's a very big opportunity between the EIIS scheme and the SCI schemes there to get investment into your business. We're going to talk about another opportunity, which is for me to invest the tax that I have paid in previous employments into my own business.
Often overlooked. It's amazing that, I suppose it's human nature. People tend to think about other people and never think about themselves. And this is something that we see as well. It's called the Sure Relief. It's the startup relief for entrepreneurs. And it was formerly called the Seed Capital Relief. So picture this. You have someone working for one of the big tech companies. They're in PAYE employment. It's been there for years. they leave the employment and set up their own business. And what they do is they have a choice. They have a choice. They either put the money into their business, their own money, their savings, in by way of a loan to the company, or else what they can do is they can put the money into the company by way of a subscription for new shares, not too dissimilar from the EIIS we spoke about earlier. In relation to a loan into the company, you will not get tax relief, but in relation to subscription for shares, you will get tax relief. And the tax relief is given as a, similar to EIIS, a tax break of up to 40% if you're a marginal rate taxpayer of the amount invested in the company. But think about this as well, like if I leave employment and invest into set up a company, and it's now 2020, and I invest in 2020, I probably have very little income, because the last thing I'm going to do for my in a startup situation is start to draw a big salary from the company. So what is the quirk or the unique feature of the SURE scheme is that you can make a retrospective claim. So I could say I invested in shares in 2020, but God, in 2017 I had a great year with my former employer. I got a good salary, I got a bonus. So you can actually elect to set your income to any of the tax years 6 years before the year in which you invest. And that's why it's more in the nature of a retrospective tax rebate than the current year tax rebate. So back to my example, 100,000 investment goes in, you'll get a check back from the Revenue Commissioners for 40. So you've got a choice. Do I plough the 40 back into the business? You put 140 to work, or do I keep the 40 so I've only put 60 at risk?
Very good. And that is subject to me having paid at least €40,000 in tax over the previous, is it 6 years?
Yeah, it usually works. The maths on this, it depends on how much you invest. So if someone invests 10,000, they should find enough income in one of those years that they might have paid tax at the high rate. If they haven't paid tax at the high rate, they say pay tax at the 20% rate, then you only get relief at the 20% rate. So you'd only get, for your 100, for every 1,000, you'd only get €200 back, rather than if you're a marginal rate taxpayer, you get 400. So it actually works better for higher earning former employees, but they typically be the people that they're talented people. They would have been talented in their employment. They probably would have been fairly well paid. So in our experience, they usually get a tax break at the top rate.
And this is called the SURE scheme, SURE. And the maximum that I can invest in my business under that scheme is?
Well, the limit's quite big. It's actually 700,000. So effectively what you could do is you could invest 700,000, go back minus 6 years, and you get a maximum of 100,000 per annum. So in the years before, you would start off with 700,000. You're only allowed to use 100. You'd hopscotch into the next year, use 100, use 100, use 100, and then in the current year use 100. Never really seen people use that amount of money, but typically it's in the 100 to 200,000 mark. Wouldn't be unusual, and they would just shelter one of the previous years that they earned.
Okay, but if I had earned €100,000 and paid tax on it at 40% in the previous 7 years, then I can get that 40K back a year.
Yeah, absolutely, and on a multiplier basis. Yeah.
Right, superb. Really interesting. And I know we have had clients in Dublin BIC who have used the SURE scheme and have benefited greatly from it. The last one we're going to talk about, Declan, is something similar to the EIIS scheme, but one that's based in the UK. Can you tell us about that?
Yeah, the UK have similar schemes. I suppose there's a couple of talking points about the UK. They have a similar scheme. They have an EIS scheme, which is an enterprise investment scheme, and they have another one called the SEED enterprise investment scheme. Similar, gives tax breaks up to 30% on the main one, 50% under the SEED one. So it's a little bit more generous under the SEED scheme. Works broadly the same. A little bit more generous in terms of capital gains tax treatment on ultimate sales, and a few other little differences along the way. The key thing to talk about probably today is the 10th of September today, and in the news this week is obviously the Brexit talks, and also the UK having issues in relation to fisheries and also in relation to state aid rules. So it'll be interesting to see if state aid rules go away, because this is a form of state aid, and there are rules of the road that we need to follow, and that's in our domestic legislation. But if the UK have a clear run at it in terms of changing the rules, then you might find that the UK regime might be more attractive or designed very differently into the future. If I just go on to Martin, just to talk about, you know, how do companies avail of it in the UK? I think it's down to the question about, you know, companies can trade with the UK or trade in the UK. So a business, you know, manufacturing jam and exporting it to the UK is trading with the UK, and on that basis wouldn't be able to claim the UK relief. But if that same business decided to set up a factory in the UK, or a distribution arm in the UK, or a branch office, or some permanent business presence in the UK, that will allow them to actually raise money under the UK scheme. So what you'd find then is that you'd have UK investors putting in money, claiming tax relief under the UK scheme. It doesn't cost the Irish exchequer or anything. But that's broadly how it would operate. But I mean, the focus of what we'd see typically would be Irish investors investing in Irish companies and claiming the Irish reliefs rather than the UK. Just watch this space in relation to what the UK might do.
And obviously forward. With the UK EIS scheme, we're talking about investment from investors based in the UK who pay tax in the UK and who can benefit from that tax refund in the UK. Absolutely.
Now, I mean, an investor in the UK could invest up to £1 million and claim tax relief at 30%. So it's a little bit more generous, but you know, that's you're talking about someone with a significant amount of personal income. So, I mean, that's the design of the scheme in the UK.
Very good. Okay. So Declan, we've talked about EIIS, we've talked about SCI, we've talked about SURE, and we've talked about the UK EIS scheme. If a micro-sized, early stage startup business needs further advice on these, I know they can get lots of information on the PwC website and elsewhere, but if they need to talk to an advisor, would such a business get a welcome in PwC?
Oh, they'll be welcomed with open arms. Yeah, absolutely. Yeah, we do a lot of work in this space, and we want to do more. And what we do is, it's interesting. It's interesting work because you're dealing with new entrepreneurs. You're seeing great technologies, new ideas. So it's good fun. It's also something that we can generate a bit of business from. But ultimately, the approach that we take would be light touch to make sure that we marry the quantity and quality of information that people want with, you know, and don't overdo it. We're also very much involved in just having general cups of coffee with people and just shoot the breeze, and then we might see them later at some other stage, but it's all part of what we do.
Okay, so it's possible to have that initial discussion.
Absolutely, yeah.
Very good. Okay, Declan Doyle, Director with the Tax Department in PwC. Thank you very much for your advice, and I know we'll be hearing a lot more from yourself and your PwC colleagues on the Sprint programme.
Thanks very much. Enjoyed the chat, Martin.